So what are the three things I was talking about in the general tax planning? It is tax structure and a calendar year versus fiscal year and accounting method. And that's why sometimes in my talk, if you go on YouTube channel, search for 3D, three-dimensional tax planning, and that is kind of the name we use all the time, three-dimensional, right? Not just a piece of paper, and you get to see yourself in the three-dimensional way, your business in three-dimensional ways. So tax structure. And if we look at this slides right here, the most common tax structure for small businesses are the following. So there's no other ones you would use on the daily basis, but these five, right? These five are something that you really want to understand in the big picture. And you may say that, well, I know sole proprietorship. I started from there and I just used my name, my social security number. I did a construction company and I am now a C Corp. You could grow from sole proprietorship to other entity, right? So that's the starting point. I will tell you that sole proprietorship, it is a Schedule C item. It is a Schedule C way of doing your business. And Schedule C has the highest audit rate in our system. If you go onto IRS website, you will see this, self-employed tax division. There is a special division set inside of IRS to take care of people who are running small businesses and under Schedule C. Because those are the group of people probably have the least knowledge, will make the most mistake, and it is easy low hanging fruits for IRS, right? They can go to your tax return and make you pay $350,000 more taxes. And if you are running in there and you can't prove what you got there, and they charge you. So one of IRS's job is to recruit and recover their income, the taxable income that they lost. So if you're under sole proprietorship, obviously for IRS, they need to make sure that you understand the compliance part of it. They come to audit you. Very easy, very normal. And then, of course, you could have LLC, limited liability company. Then you may say that, well, when I set up a business, I go to my attorney, and my attorney just automatically says that, okay, let's do a LLC. So LLC, there's a reason why the attorney setting you up as an LLC, not a C corp, because obviously the price the attorney charges you would be a lot less under LLC. So they're coming out of that angle. You're a small business, just started. Let's not put a lot of burden on you. Let's just do an LLC. But LLC has flexibility, and you can make yourself paying taxes like S corp and C corp. But then you can, of course, step in as an S corp already or as a C corp. So those are all different ways for you to think of, oh, my business can be under all of these items, under all of these structures. Then if I use a house as an example to say that, what does that mean? So sole proprietorship is almost like your growing up child refused to move out of your house, but he's old enough that to be on his own, but he's still staying in your house. That's sole proprietor. And LLC, it is basically a townhome, and it is not exactly there yet, has a detached the other side, no garage, and it's just a very, it's a gateway for you to get into business world. Your attorney gave that to you, told you that, okay, if you are under LLC, you don't have to have liability. Your business liability is kind of in the box, so it's not gonna impact you, and that's why it's called a limited liability company, right? Then if you have an S corp, that's almost like you have a single standalone home, but in this household, and I will describe that as you have a lot more families than just you. The reason I say that is because S corp, in my easy way to explain it to you, the difference between S corp and C corp are a society identification. So the S corp means that everyone inside of your corporation, your employee, yourself, and you have to go a approach like a socialism. Means that if you want to give yourself a health insurance benefit, then all of your employees who work full time with you, and they also qualify. If you want to do a 401k, then they also qualify. So it is a socialism society where the owner employee really is no different from the employee. And a lot of companies in Iowa are purposefully that way because that's how they want to spread out the success to other employees. And they set up things inside of S Corp and benefiting everyone with no special privilege to the shareholder or to the owner. C Corp stands for Capitalism Corporation. Capitalism Corporation just means that it is a privately held company. The goal is to grow capital, grow income for a small elite group of people, like executives, shareholders. So you hear, I think the most important identification on the C Corp is that you can produce, you can design a benefit inside of C Corp that would only benefiting those elite small group of people. But in S Corp, that is accomplished much more difficult, not much more harder than in the C Corp. So C Corp, S Corp, LLC, sole proprietor, you can see the difference, the emphasis in that structure. Then of course, in what case people want to do a C Corp? And the C Corp has identity as a privately, well, of course, there's a public company and you going on IPO, then you become a public company. But if it is privately held and controlled corporation, you don't have to publish your financial statement. Now, how much money you make in the C Corp, it doesn't need to be known to people other than your small shareholders group, right? And that C Corporation can completely go away from your lifestyle. So if you know that, how many bankruptcy are President Trump had filed in the past, he filed many. And those bankruptcies are C Corp bankruptcies. So they are not affecting his personal wealth, right? So that's how effectively, as a business owner, you can separating your personal side of things from your business. And why people wants to be in the C Corp. I would say that, the the bars and some businesses has higher risk. For example, the bars, right? People drinking there and they get into trouble, and there's a lot of things need to be done, and it's not like a CPA firm. Am I right? So people would set that up as a C corp. It's totally understandable. And of course, we also listed another kind of tax structures for small businesses and the small business owners that is not for profit. Then now you are saying that, oh, why do you list that there? It is so important. And you heard of Clinton Foundation, you heard of Wells Fargo Foundation. What are these? These are not organization tightly related to the profit making company. So Wells Fargo Foundation is actually taking money from Wells Fargo and into the foundation, then doing things that is benefiting to the community. But when a company move money from their operation to a nonprofit, what does that do? That would reduce the taxable income on your company. Am I right? So some of our successful small business owners, and they would support certain nonprofit. But if the nonprofit out there has nothing to do with you, and you don't feel like you are going to utilize any of them, and of course you can form your own. So this is where the structures coming in really make you think hard. And I will give you example of community CPA, right? Community CPA is just like you. We grow from one person to 40 people. We grow from one location to three, four other locations. And in this growth, we also recognize the community needs. That's why we have supported a nonprofit called Immigrant Entrepreneur Summit. And that IES is a nonprofit. And I was one of the original founder for IES. So that nonprofit, what we do is Community CPA will write a check every year to IES. And Wells Fargo did that too for 15 years. So Wells Fargo write a check, Community CPA write a check, US Bank also write a check. So these people will put money together under IES. So it accomplished one thing, to teach small business owners to get into business fast, right? So this is an example of how you can see what you do. If you are a successful construction company business owner and you want to establish certain nonprofit purpose activities, you can literally structure a nonprofit, form a nonprofit, and then the money you put out to the nonprofit is deductible. So this is where we're talking about tax structure is so important. Of course, let's just talk about dollars. If I have $100 net profit under sole proprietorship, you can write that down. I give you this number. If you have net profit of $100 under sole proprietorship, and you will be paying $30 taxes. I assume self-employment tax is 15% and your income tax is 15%. So $100, $30 goes on taxes. LLC. If your LLC is just yourself, and then your taxes is exactly the same as how sole proprietorship would pay. So it's $100, you pay $30 taxes. But what about S corp? If you make $100 inside of S corp and you're paying $15 income tax. But if you make $100 inside of C corp, you are paying $21 income tax. Did I give you a really clear picture right here, right now? So I know you hear S corp. So that's reason why a lot of companies out there and they are S corp. And you say, well, no, they're all LLC. I don't think they're S corp, Ying. I know they're LLC because the LLC is on their name. Just remember, we go to the next slide. And our next slide shows you that even though their name is LLC, but they can elect themselves to be an S corp and a C corp. Did you see the first box on your left hand side top? That's LLC. Those dotted arrow to S corp C corp just means that a LLC can elect itself to be S corp C corp. See that as a lady, I can dress up to be a Halloween and Scooby Doo, or I can dress up to be a boy, right? So I'm not changing myself from LLC. I am just electing treatment for my business to take advantage of S Corp low taxes, to take advantage of C Corp separating my interest from the company interest. And setting up so many benefits under C Corp don't have to consider this socialism, capitalism difference between the two corporations. Now, let's look at these boxes, folks. So you see on your right side, I wrote 1040 in there, right? So when you are sole proprietor, you are the Schedule C. And when you are single member LLC, you are also under 1040, you are filing Schedule C. They're two, the same thing if you are a single member. But of course, if you have you and your spouse and doing the LLC together, then you belongs to that multi-member LLC on your left-hand side on the top. All right. So now look at the dotted line inside of the 1040 form, and that can be elected again, right? The single member LLC can be elected to be S Corp, C Corp, and LLC, just like what it shows here. But if you are doing a Schedule C without a LLC, just your name and your social security number, then folks, you cannot elect anywhere. You are you, and there is no identity for the tax treatment to exist. So at a minimum, you need to be a single member LLC before the election can happen. Now let's look at the S corp. Under the In the S corp box, you also see the dotted line to C corp. That is a revocation of S corp becoming a C corp. So you might have a question for me saying that, Ying, I'm S corp right now. And I also like what you're saying about C corp, but when is my time to make myself a C corp, not S corp anymore? Because all kind of reasons, right? Maybe you want to separate your personal taxes from your company tax for reasons. Maybe you're going divorce, and maybe your business had issues that you worried about that would connect to your personal, whatever reason. Because you see that LLC multi-member and S corp, they all have this K1. Where did they go? They all went into 1040, went into your personal, right? So those are the things you would ultimately, if someone look at your 1040, they go, oh yeah, you have this company, you have that company, and if I sue you, maybe I can sue more because obviously you got more, right? So these are legitimate concerns as a business owner, and you want to know when exactly you want to do that. So let me give you a dollar amount. This is by our experience. It is a very important threshold that we talk to our client all the time. Let me give that to you. And if you are a S corp, and when you have a profit more than a quarter of a million, 250,000 come out as a net profit for you, that is when it might be better off to revoke yourself back into C corp. Okay. And we say that carefully because there's other considerations we won't be able to cover today, but it is something that I want to plant the seed in your mind. So when you got there, you're thinking, man, I'm paying too much taxes. And is there a way to make my taxes more efficient? The answer is yes, there is a way. Okay. And then at what point of time you would want to elect LLC to be a S corp? Let me tell you this. If you are on Schedule C, your name and your social security number, you are running something, it's almost something you like, and not carefully, you may even say, oh, that's my hobby. You can't run a hobby on the Schedule C, but it feels that way because you just love it. You just did it by habit, right? So if you make more than $20,000 net profit, that really means you should be electing yourself to be S corp. So you have 20,000 threshold under 1040, then you have a quarter of a million threshold under S corp. I apologize. Just feel like to cough. Okay. So with that said, let's look at what's under the line, the dotted lines there. So we have a C corp and we have a nonprofit, right? So you can see the only connection the C corp and nonprofit has with you, with your 1040, is what? Is W-2 from C corp and the 1099 dividend from C corp. And with your nonprofit, just give me a second. I need some water. I don't have water here. Didn't prepare myself, so I didn't have water. Okay. Under nonprofit, the only place it can go is W-2. If nonprofit hired you to work, they give you W-2, you report on 1040. But here, there's a one line I did not draw for you because that is every box we see here. Your 1040, your LLC, your S corp, and your C corp, they all can what? donate to nonprofit. When they donate, what happens? You have a deduction, right? So especially coming out of the business, you have a deduction for sure. And if it is come out of 1040, of course, you're limited to the Schedule A, so we can talk more detail about that. But the general rule is when you donate to a nonprofit, that is your expense, and you will not pay taxes for that amount, right? All right. So we had talked a lot about tax structure. So that's only one dimensional thinking I want you to master. Then let's talk about fiscal year versus calendar year. What's a big deal about this? It's such a big deal, folks. And but it's always get ignored because people don't think in this second dimension. All right. So let's say you are in construction business. All of your activity happens in the summer. And in the winter, you actually don't have a lot of activities, but you might do a lot of purchase. You might do a lot of preparation, and you might even go on to other state, other places to visit other constructions. Who knows? You spend money. When you are not busy, you spend money. So let me ask you a question. So you made money in the summer, let's say between April to the end of September, or let's say end of October, you made money. So November, December, January, February, March, 5 months, you are not doing as much. So these 5 months, you spend more and you make less compared to your other 7 months. Am I right? So if you make your year end at the end of March, for me, if you make your year end first, what happens? The money you made from April 1st all the way to October, and plus all the expenses you do till the end of March, so you have a complete normal business cycle. Am I right? You made money, you spend money. So at the end of March, you sit there goes, I have 50,000 in my bank account. That's your real money. Am I right? Because that's the money you made after the complete business cycle. The problem with a lot of our folks is that we go for calendar year. We think it's almost like 1040. Of course, we can't do any other ways for 1040, okay, folks? 1040 is always January to December. But let's say if you are going for January, December, and you make all your money in December. For example, you are a Christmas, you are Christmas related company. You make money in November and December. So at the end of December, you already need to calculate how much you need to pay taxes. Don't you pay more because you actually just made it? You hasn't even paid all the supplies you got yet, right? So this is where the years is really important. And because of you setting your year in the wrong place, that could hurt your business so much. You felt like you never have money because you're always paying taxes at the most time you have cash, right? You're not allowing your business to complete the cycle before you pay taxes. So is the physical year. And so if we go down to I only had one slide in this one. So you can see I listed some seasonal businesses, food truck, outdoor adventure business, like outdoor entertainment, personal trainer, and the lawn care, Christmas lighting, chimney, and a specialty realtor construction is another one, right? So just understand that dimension. You don't have to practice it right away, but just have that in your mind. You are already asking a good question. When you start your business, ask that question. Ask the attorney, and can we file on fiscal year? And can you apply for fiscal year? And if you didn't do that in the very beginning, you can still apply to IRS to do that, right? IRS allow you to do that. So let's go to our third dimension. This is our last one. And remember, we three-dimensional tax planning thinking. So the first one was tax structure. that I already gave you the dollar amount, right? So for $100 profit, if you are one way, you pay $30. If you are another way, you only pay $15. And if you are another way, you pay $21. And of course, if you made $100 in nonprofit, you don't even pay taxes. That's $0, right? So that's the structure side of it. Then we talked about the years and where your business cycle determines your balance in your bank account. The way to look at this business is so special. I don't really know what is my cycle, and that's okay. And what I want you to do is to look at your total and to see which one to give you the least deposit in the year, which period. Or if you say I'm the same, then you may be not really critical for that way of thinking, right? It's only critical for seasonal businesses. Accounting method. Accounting method is really one of the most complex thinking a person would want to think when you run your business. But of course, it's accountant's job. It's really not our business owner's job. But I want you to know to ask that question. Every time when if we have clients got transferred into our firm, and we ask them what accounting method you're using, because we know that for that kind of business, the best accounting method is this. So we ask, what do you use? Most of the time, our answer we get from our clients, we don't know. So let me tell you something. When you go to your tax preparer, they running your tax return, and if they didn't ask you this question, and what they are doing is the return, the softwares, those tax software company, they did the software defaulting everything on cash method. That's just how it is. If you don't go in to make a change, they defaulted to cash. So if you say you don't know, then most likely you are cash accounting. No, no question about it, because you were defaulted into that way. Now, and what is the big deal between cash accounting and versus accrual accounting? So let me give you an example first before we look at the first slide. Okay. So if I have a grocery store operating coming to our firm, and in fact, the best accounting method is accrual method. The reason I say that, because accrual means that even though you haven't really paid the expense yet, as long as it's in use, you can deduct it. And even though you haven't even get all the income yet, but if you know you're getting it, you would count that as income. That's kind of the summary of accrual method. So in grocery store or in retail, you normally don't know what you're getting in the future, because people come in, they buy it right in front of your POS system, right? So your operation is going to put you into almost like a cash method. You receive for what you got. So your income will never overstate it, because you just report what you receive, right? So with that said, you are on accrual, that you got nothing to accrue. You're just gonna be reporting what you got. But on the expense side, you normally have a 30-day net, 15 days net. You already got stuff to sell, but you haven't even paid it yet. And if you are under accrual, that means you can deduct that invoice even though it is still a payable you didn't pay. Imagine if you are a cash method. Then if you did not pay, I'm sorry, you cannot deduct that, because it didn't go out of your bank yet. The cash method only count on the cash going in and out. They don't really allow you to have any imagination of what you're going to pay later. So retail stores on cash method or on accrual, of course it's accrual. But what if you run a dental office? Do you want to be on cash or you want to be on accrual? On cash. Why? because when treatment when the bills got submitted to the insurance company, they're discounting so wildly. No dentist knows what they get paid from the insurance company. They can pay them whatever you use different insurances, different amount. Your age coming in, the Medicaid is different amount. There's so many things. They don't really have a good count on the future income. They just submit. So whatever deposit is what their income is. So you want to be on cash because you don't want to report what you submitted to the insurance. You want to just report on the amount that comes in. On the expense side, most of the dental office has a good cash flow. They don't have any need to sit on some payment for a month or two not paying. So they actually write a check, pay it, so they also can deduct their expenses timely whenever they got paid. So in general, we see majority of the dental offices are on cash method, and most of the retail business, if they are coming to our community CPA, that's what we're gonna put them on accrual method. And of course, I'm facing a lot of you who maybe have relatives and maybe running that business on the side, but majority of you are in construction business. Then you will say that, well, Ying, okay, we understand the cash basis and the accrual basis on the construction, the best way to do on accounting. So, Mary, if we can go slowly on these slides. So we move down to cash basis, right? This is accounting method in general slide. Then let's go down to the next one. That's cash base. So we explained about cash base. We explained about accrual method. So let's go down to the next one. So here it is something I want you to consider when you run accounting and what do you do for a practical method that you would use. So let's go on to the next slide. So one of the key ones I have here, it is based on project. So, you don't have to go into the details of the slides, but I want to explain to you about the concept. Sometimes when you quoted a project, say $2 million is this big project, and it would get finished by different timing. So the most way people are using accounting method, the most common way for those large projects is percentage of completion. Percentage of completion just means that you don't recognize income based on the deposit that come to you. You recognize income if that portion of job is completed. Say the first portion is laying the basement, laying the laying the base. Let's say that is a $500,000 job, and when you know the materials is 300,000, and you got your labor budgeted for 200,000, when you finish this piece of the whole building, $2 million project, then you recognize the income you got here. If your total budget is 500,000, you paid your material, you paid your labor, then you got to zero. That just means you have no profit, and you're just going to recognize zero income, and you recognize the $500,000. Either the bank paid you because your client is borrowing money from the bank, or your client paid you whatever deposit you made into your bank account, and you will minus those materials, labor that related to it. And if you made 0% profit, 0% profit, you could very well be making money on the very last step. So that is a percentage completion. Okay. Of course, you can also use percentage of contract completion, project completion, and you also have an option to do cash. I would never recommend construction company going on cash method, and you want to look at a completion method. So that's a project-based accounting. And once you account it that way, you probably a little bit of worry about me saying, oh, Ying, you just say accounting and nobody look at accounting. I just care about taxes. I just want to know how this is going to be on tax. Remember, folks, your accounting is that working to give you the income statement balance sheet, right? You do all these accounting, then you give your tax preparer that income statement and the balance sheet. You got to get all of these done on accounting, and your tax person really don't need to understand accounting. And you may realize that some people just open up a software, goes, oh yeah, give me the number, put that in, and your tax is done, right? A lot of people claim they know how to file taxes only because they know how to use that computer program. In case, if you work with someone like that, it's not a big deal. And you just need to make sure your financials were done properly with correct accounting method. All right, let's go down to the next slides. And I actually just gonna briefly talk about the overbilling liabilities and the contract retainage. So those terms I know you are familiar with, but understand these are balance sheet entries. When I say balance sheet entry, means that they are not something you calculate income tax on. These are all balance sheet entries. So you cannot, let's say you did a contract for 100,000, then the people who's supposed to pay 100,000 only give you 90,000 because they have a 6 months 6 months warranty period. You know, they need to use it for 6 months, then they give you the 10%. Did you really make the cent? You didn't, because it's retained by the client. It's not yours yet. So in in accounting, when you do product completion and when you are not going by the cash method, and then these are staying on balance sheet for you. And this is where, for construction company, I will tell you that your bookkeeper is much more requires a lot more knowledge to your bookkeeper than the bookkeeper next door. You are in the business that has a lot to do with the balance sheet. But of course, remember, we will talk about specifically how we're going to work on tax and accounting on December 7th, right? That's another time I will come in. I'll be very specific with construction company business owners and what you would do and what our experience tells you. So on that day, I'll dive in deeper for you just for your end of business. So let's go to the next slide, which is the job costing and decentralized production. These two slides are also accounting method that you can follow, which means that it is a per job costing analysis. Then you will tie that to the job income, tie that to the job costing. And can you go down to the next slide called decentralized production? This happens to larger construction company where when you have a construction work or job or project, you're actually moving all your equipment over. So you actually would incur cost. We call that mobilization cost. Mobilization cost is you moving equipment around, reset on the work site, and then use there for a period of time, 2 months, 3 months, and it just depends on how long the project is. So decentralized production requires you to document that cost related to the project. So a lot of times, and you don't see that because people they still paid payroll and they still run the expenses, but they probably stuck that in another project or just left it on the general column. Oh, that's my general expense. No, as a construction company, you want to make sure you have a column, you have a cost category that is allowing you to spend labor and material into relocation, because that is just a nature of the beast. There is nothing, there is not wrong for you to track that on each job, so you can give your customer the correct billing, right? All right. So the last slide of related to the accounting method is the last page, selecting the best accounting method. So this is where, and we tell folks that when you are in the construction company kind of business, and your accounting method may grow with you. And you may be thinking, oh, I'm too small right now. Let's not bother with project completion. Or you say that my project is so short and normally it takes 3 months, so I have no need for the completion method. It's all good. But knowing the options, have all the cards in your hand, that's when, as a business owner, you can really visioning yourself to scale. If you don't know, I always say that the only difference between you and the Elon Musk is not because he is smarter and he got a good opportunity. It is really about the knowledge. He has the knowledge you do not have. And he's in the area that you don't even tap into. So the knowledge is really the key to whatever success you're looking for. And in accounting and taxes, if you don't know, you just don't know. And I'll give you a really, it's a work that our firm did. It was really alarming to me because I can see how important that is for a knowledge to come into play. We have a client who sold her business for $15 million. And so the tax preparer did taxes. So she is scheduled to pay $8.2 million taxes. Okay. She didn't think it's right. She didn't think she think it's too much. She's already spent half of the money. Now she doesn't even have money to pay taxes. So she came to our firm and not knowing that she should not be paying any taxes if the right tax code is supplied. And she happened to qualify for that. So she ended up walking away with $50 million not paying taxes. So that's the knowledge difference. That is where, of course, in terms of accounting method and in terms of fiscal years, tax structures is not going to be earth shattering $50 million difference. But imagine if you are in business for 15 years, for 20 years, then each year you could have $100,000 difference. That's accumulation of a lot of difference. So again, tax planning is not just a bothersome, a short recommendation from these tax people who has no good things to do. It is really a lifestyle that I am preaching for everyone to have. If you are the person buying life insurance, planning for accident to happen, pay money for insurance, why are you not doing that for tax planning? That doesn't even make any sense. But of course, if you don't buy insurance, you don't care about afterlife, and you just want to live for the moment, and then there is one moment in the year, it's called the tax planning moment. You can just think of these three-dimensional thoughts we had shared today and really come up with your question and go to your tax preparer or come to Community CPA and we will take care of you. And we have that knowledge. We also have that compassion. We don't want people to miss out opportunities to save taxes so they can do better and a better business for themselves and for the community.